They took their best shot. They waited for the cover of darkness. They raised the margin requirements. They flooded the order book with paper shorts. They painted the tape red going into the weekend. For 48 hours, they wanted you to believe that the silver bull run was over. They wanted you to believe that the crash had arrived. But when the sun rose over London this morning, the smoke cleared and the bull was still standing. We have just witnessed one of the most significant market signals of the last decade. It wasn't a press conference. It wasn't a Fed announcement. It was the price action itself. The market didn't just recover, it exploded. The massive gap up we are seeing, erasing the losses of the previous sell-off in a single session, is not normal market behavior. It is a scream. It is the sound of a bear trap snapping shut on the fingers of the biggest banks in the world. It is the sound of the short sellers realizing that there is no physical metal left to back their paper bets. And it is the confirmation that the buy-the-dip mentality has shifted from retail traders on Reddit to sovereign nations and industrial giants. If you panicked and sold during the drop, I have bad news for you. You were the liquidity they needed. You were the fuel for this rocket. But if you understood the game, you are watching vindication in real time. In this deep dive market analysis, we are not going to look at predictions. We are going to look at the crime scene. We are going to dissect exactly how the banks tried to kill the price and why, for the first time in 40 years, their weapon jammed. We are going to explain the mechanics of the V-shaped recovery and why this specific pattern signals that the low is in. The paper price tried to lie to you. The physical market just told the truth. This is the anatomy of a failed crash. To understand the violence of this rally, you have to understand the trap that preceded it. In financial markets, nothing moves in a straight line. Bull markets are designed to buck you off. They are designed to cause maximum pain to the maximum number of people. What we saw recently, the sharp, sudden drop that terrified everyone, was a classic textbook bear trap. Here's how the mechanism works. The banks know where the stop-loss orders are. They know that thousands of retail traders set their automatic sell orders just below key psychological levels like $60 or $62. To get liquidity, the banks have to trigger those orders. They use a catalyst, like a margin hike or a scary news headline, to push the price down just enough to hit those triggers. Snap! The stops fire. The retail traders sell automatically. The price creates a scary red candle. This convinces the bears that the trend is broken. They pile in, they short the market. They bet the house that silver is going back to $50. But then the trap closes. Because the banks aren't selling to exit. They are selling to buy. They push the price down to generate the selling volume. And then they absorb it all. They buy the contracts from the panicked retail traders. They buy the contracts from the overconfident bears. And once they have filled their bags, they step away. Without the artificial selling pressure, the natural demand takes over like a coiled spring. The price rips higher. It gaps up overnight. And suddenly, everyone who sold at the bottom is left with cash they don't want. And everyone who shorted at the bottom is underwater. They have to panic buy to cover their losses. Their buying fuels the rally even more. This is exactly what just happened. The drop was fake. The recovery is real. The violence of the move up tells you everything you need to know about the strength of the underlying market. Weak markets bounce like a dead cat. Strong markets bounce like a tennis ball. Silver just bounced like a Super Bowl. We talked previously about the margin nuke, the exchange raising capital requirements to force selling. Historically, this is the ultimate weapon. In 2011, it worked perfectly. They raised margins, and silver collapsed 30% in days. It scared the speculators away for a decade. They tried it again this time. They raised the cost of doing business. They tried to make it too expensive for you to hold your position, and initially it looked like it worked. The price dipped. But then something unprecedented happened. The market absorbed the blow. Why? Because the composition of the market has changed fundamentally. In 2011, the market was dominated by weak hands, speculators using 20x leverage who could not afford the margin call. When the call came, they had to sell. Today, the market is dominated by strong hands, industrial users, family offices, and sovereign wealth funds. These entities are not gambling. They are hedging supply chains. They are protecting wealth. They have deep pockets. When the exchange said, you need to put up more cash, these buyers didn't sell. They wired the cash. This is a disastrous signal for the manipulators. It means their pain threshold calculation is wrong. They thought a 50% margin hike would break the back of the bull. Instead, it just annoyed the bull. When a market ignores bad news or regulatory attacks, it is a sign of extreme underlying strength. It means the buyers are not price sensitive. They are volume sensitive. They care more about getting the silver than what the margin requirement is. The failure of the margin nuke to sustain a crash is the all-clear signal for the next leg higher. The banks have fired their silver bullet, and now they are standing there with an empty gun staring at a charging rhino. Let's talk about what this does to the psychology of the market. Markets run on two engines, greed and fear. But there is a third, more powerful engine, regret. The V-shaped recovery, where the price crashes and immediately recovers to new highs, is a regret machine. Think about the guy who sold on Friday. He was scared. He saw the red numbers. He thought he was being smart. He thought, I'll sell now and buy back lower at $55. He went to bed feeling safe. Then he woke up on Monday, and silver is higher than where he sold it. He didn't save money. He lost his position. Now he has to make a choice. Admit he was wrong and buy back in at a higher price, or wait and pray for another crash. Most people wait. They refuse to buy back higher. They watch the price go to $65, $68, $70. The regret turns into FOMO. Eventually they panic and buy back in at the top. This is how bubbles are formed. The shakeout removes the weak believers early, leaves the train lighter so it can travel faster, and it forces the skeptics to chase the price. This recent volatility was a cleansing event. It washed out the leverage. It reset the sentiment. It turned overbought conditions into neutral conditions without actually breaking the trend. Technically speaking, it was a masterpiece of market structure. Whether it was engineered by the banks or just natural volatility, the result is the same. The path of least resistance is now higher. But who bought the dip? It wasn't retail investors. Retail was scared. The volume data tells a different story. The buying started in Asia, but it accelerated in London. This is the critical piece of the puzzle. For years, London has been the source of supply. It has been the seller of last resort. But this morning, something changed. London switched sides. In the next part, we will investigate the London pivot. We will look at why the bullion banks in the UK, who traditionally suppressed the price, are suddenly panic buying physical metal. We will explore the rumor that the float has hit zero. We will explain why this shift in institutional behavior guarantees that the previous highs will be taken out. The bear trap was just the setup. The London pivot is the fuel. Don't go anywhere. We need to talk about the float. If you're just joining us, let's recap the crime scene. Friday was the smash. Sunday night was the gap up. But the real story, the story that will define the next 6 months of this bull market, happened just a few hours ago in London. For 40 years, London has been the suppression capital of the precious metals world. The London Bullion Market Association is where the big banks trade. It is where the fix is set. Historically, when the price got too high, London would flood the market with supply. They were the seller of last resort. Whenever New York panic bought, London would calmly sell and cool the market down. But today, London didn't sell. London panic bought. When the market opened in the UK, we saw massive aggressive bid orders hitting the tape. This is a change of character for the market. It is like watching a firefighter start pouring gasoline on the fire instead of water. Why did they switch sides? Why are the bullion banks suddenly chasing the price up instead of smashing it down? It isn't because they became silver bugs. Banks don't have ideology. They have liabilities. They switched sides because of one terrifying metric that the public rarely sees: the float. We talk about inventory all the time, but inventory and float are not the same thing. Inventory is the metal in the vault. Float is the metal available for sale. In the next part, we will expose the collapse of the silver float. We will explain the leasing machine that the banks used to suppress the price and why that machine just broke. And we will show you why the seller of last resort has just become the buyer of first resort. The bear trap caught the retail shorts, but the float trap just caught the banks. Let's clarify a misconception. Bearish analysts love to point to the LBMA vault data and say, look, there are still 800 million ounces in the London vaults. There is no shortage. They are technically right about the number, but they are completely wrong about the meaning. That 800 million ounces is an iceberg. The vast majority of that metal, probably 85% to 90%, is spoken for. It is owned by ETFs. It is owned by sovereign wealth funds. It is owned by family offices who vaulted it in 2010 and threw away the key. That metal is not for sale. It is strategic inventory. It sits there collecting dust. It does not move at $30 and it won't move at $60. The only metal that matters to the price is the float. This is the unallocated metal, the metal that sits in the dealer pot, the metal that can be leased to a refinery, sold to Apple, or delivered to the COMEX. Historically, the float was massive, hundreds of millions of ounces. But over the last 3 years, as India bought 2,000 tons here and 1,000 tons there, they didn't buy the ETF metal. They bought the float. They drained the dealer pot. So today, when we look at London, the iceberg is still there. But the tip, the float, is gone. It is melted. This creates a liquidity crisis. If Samsung needs 1 million ounces today, they can't buy the ETF metal. They have to buy the float. But the float is empty. So the price has to rise high enough to convince the diamond hands to sell. That price ain't $60. It probably ain't $100. We are in a situation where the available supply is effectively zero, even if the total supply looks healthy on a spreadsheet. This is why London panicked today. The banks looked in the dealer pot to smash the price and found it empty. To understand why the banks are buying, you have to understand the leasing market. This is the dark heart of the silver trade. Bullion banks don't just sit on silver, they lease it out. They lend silver to industrial users like refineries or electronics makers. The user takes the silver, uses it, and promises to return it later, plus interest. This system allows the industry to function without buying the metal outright. It also allows the banks to make money on their stack. And crucially, it creates virtual supply. The same ounce of silver can be leased out, returned, and leased again. It creates the illusion of liquidity. But here's the problem. What happens if the industrial user consumes the silver? What if they turn it into a solar panel or a missile? They can't return the metal. They have to go into the open market, buy a new bar, and give that to the bank to close the lease. For years, this was easy. Silver was cheap. But now, refineries are halted. The float is gone. The industrial users are calling the banks and saying, we can't return the metal. We can't find any to buy. This causes the silver lease rates to spike. When lease rates spike, it is the market screaming shortage. It means banks are desperate to get their physical metal back. Today, we are seeing signs that the leasing machine has jammed. The banks realize that the metal they leased out is never coming back. It's gone. It's on a roof in Germany. It's in a Tesla in California. So the banks have a hole in their balance sheet. They show silver asset on their books, but the vault is empty. To fix this, they have to go into the spot market and buy physical bars to replace the ones that were consumed. This is the London pivot. The banks are not speculating on a price rise. They are frantically trying to fill the hole in their vault before the regulators notice. They are short covering on a physical level. This buying is insensitive to price. They don't care if it's $63 or $65. They need the metal to balance their books. This is the most explosive kind of buying pressure imaginable. There's a final layer to the London panic, the unallocated account. Many wealthy investors and institutions hold silver in unallocated accounts in London. This means you don't own specific bars. You own a claim on a pool of silver held by the bank. It's like depositing cash. You don't own the specific bills. You own a claim on the bank's liquidity. For decades, banks ran a fractional reserve silver system. They might hold 100 ounces of physical silver for every 500 ounces of claims they sold. They assumed that not everyone would ask for their metal at once. But the Samsung news and the Friday volatility scared the big money. Family offices are starting to say, you know what? I don't trust the unallocated account anymore. I want to convert to allocated. I want my specific bars. I want to see the serial numbers. I want the move to a private vault. This is a bank run on silver. When a client converts from unallocated to allocated, the bank has to take 1,000 ounces out of the general pool and put a name tag on it. That silver is now removed from the float. If the bank was running fractional, holding only 20% real metal, and 30% of clients demand allocation, the bank is insolvent. They have to rush to the market and buy the missing bars. This is exactly what fueled the rally this morning. It is a silent bank run. It isn't guys in t-shirts lining up at a coin shop. It is billionaires sending legal notices to bullion banks demanding physical segregation of assets. And the banks are buying the dip to fulfill these demands. They tried to crash the price on Friday to scare these people away. It failed. The demand for allocation actually increased over the weekend. So now the banks are forced buyers. So we have the bear trap, we have the London pivot and the leasing crisis. The stage is set. We are currently trading around $63.35. Directly overhead lies the psychological barrier of $65. If we break $65, the chart opens up. There is virtually no resistance until the all-time highs. In the next part, we will show you the technical roadmap for the week. We will explain why $65 is the line in the sand for the short sellers. And we will tell you exactly what to expect when the U.S. market opens in a few hours. Will the Americans join the buying party, or will the Fed try one last intervention? The float is gone. The banks are trapped. The squeeze is on. If you have been following this breakdown, you know the fundamentals. The bear trap has failed. The London float is empty. The physical buyers are in control. But now we have to look at the technicals, because even in a supply shortage, price doesn't go up in a straight line. It moves from battle to battle. And right now, the entire silver market is staring at one specific number, $65. We are trading around $63.35. We have recovered the Friday losses. But $65 is different. $65 isn't just a resistance level. It is the kill zone for the short sellers. In the next part, we will explain why the banks will fight to the death to defend $65 this week. We will explain the gamma squeeze mechanism, the hidden force in the options market that could force the price to go vertical if that wall is breached. And we will tell you exactly what to expect when the United States wakes up in a few hours. The easy part was bouncing back. The hard part is breaking through. Here's the roadmap for the next 24 hours. Why is $65 so important? Is it magic? No, it is liability. In the derivatives market, speculators buy call options. These are bets that the price will go up. Right now, there's a massive concentration of open interest at the 65 strike price for the December and January contracts. Millions of ounces are betting on a break above 65. Here is the problem for the banks who sold those options. If silver stays below 65, those options expire worthless. The banks keep the premium, they win. But if silver crosses $65, the banks are on the hook to deliver millions of ounces at a discount. This creates a phenomenon called delta hedging. As the price gets closer to $65, the market makers get nervous. Their computer algorithms force them to buy silver futures to hedge their risk. If they sold a call option on 5,000 ounces, they might have to buy 2,000 ounces of futures just to be safe. But here's the catch. Their buying pushes the price higher, which makes them even more nervous. So they have to buy more futures, which pushes the price even higher. This is called a gamma squeeze. It is a self-reinforcing feedback loop. It is what happened to GameStop. It is what happened to Tesla, and it is waiting to happen to silver. If we break $65 with volume, the market makers flip from being neutral to being forced buyers. They will have to chase the price to $66, $67, $68 just to cover their exposure. This is the vacuum effect we talked about. Above $65, the air is thin. The resistance disappears because the defenders become the buyers. This is why you will see massive volatility around $64.80 or $64.90. The banks will throw everything they have at that level to prevent the dam from breaking. They will sell paper. They will trigger stops. But if the physical demand from London and Asia keeps pushing, the dam will burst. We are approaching the U.S. market open. This is the moment of truth. Usually the U.S. Open is where rallies go to die. For years we have seen the pattern. Asia buys, London buys, and then New York opens and smashes the price. It is almost like clockwork. The 10 a.m. smash. But today feels different. Why? Because the American investor is waking up to the same news that panicked London. They are reading about the Samsung battery. They are seeing the China export rumors. And crucially, they are seeing the green chart. Americans are momentum chasers. When they see silver up $1.60 overnight, they don't think it's too expensive. They think, I'm missing out. FOMO is a powerful drug. We are likely to see a wave of retail buying hit the ETFs at the open. This inflow of cash forces the ETFs to buy metal to match the demand. This adds another layer of buying pressure on top of the London bid. However, there is an adversary, the dollar index. The Federal Reserve and the U.S. Treasury watch the silver price closely. Runaway silver is a signal of runaway inflation. It makes the dollar look weak. Often during the U.S. session, you will see a sudden rally in the dollar index to try and cool off commodities. So the battle at the U.S. Open will be the FOMO crowd versus the dollar defense team. If the price holds steady through the morning session, if we don't see a massive reversal, then the shorts are in serious trouble. It means the dollar defense failed. It means the U.S. investors have joined the global stampede. Watch the volume. If volume is high and price is rising, the rally is real. If price rises on low volume, be careful. It could be a trap. But given the bear trap set up from Friday, the odds favor the bulls. There is one more signal we need to watch today, the mining stocks. On Friday, when silver dropped, the miners got hammered. Stocks like First Majestic, Pan American, and Hecla dropped 4% or 5%. Investors treated them like the world was ending. But today, silver is back up. Mathematically, the miners should gap up massively at the open. If silver is 63.35, these companies are printing cash. However, miners often lag the physical metal at turning points. Wall Street is slow. They wait for confirmation. They want to make sure the silver rally isn't a head fake. This creates a temporary arbitrage opportunity for the astute investor. If silver holds these gains, the mining stocks must catch up. It is basic math. The rubber band between the metal price and the stock price is stretched to the breaking point. When the U.S. market opens, watch the Junior Silver Miners ETF. If silver is up 3%, CLJ should be up 6% or 7%. If CLJ is only up 2%, that is an opportunity. It means the stocks are on sale relative to the commodity they produce. This disconnect happens because equity traders are scared. They remember Friday. But commodity traders know the shortage is real. Eventually, the equity traders will panic buy the miners. The catch-up trade can be explosive. So we have the setup. We have the $65 gamma wall. We have the US FOMO wave. We have the mining stock catch-up. The next 24 hours will be volatile. You will see spikes. You will see dips. But you must not lose sight of the forest for the trees. Whether silver closes today at $60 or $64 or $66 is relevant for traders. But for investors, it is noise because the forces driving this move, the Samsung battery, the China hoard, the empty vaults, are not day trade forces. They are structural forces. They don't disappear at the closing bell. In the final part, we will zoom out. We will give you the end-of-year target based on this new momentum. And we will leave you with the final psychological armor you need to survive the volatility of the coming week. The bear trap has snapped. The rocket has cleared the tower. Now we just have to hold on. We have reached the conclusion of this market alert. We have dissected the bear trap that failed on Friday. We have exposed the London pivot, where banks turned from sellers to buyers. We have analyzed the gamma wall at $65 that is currently shaking. But now I want to zoom out. It is easy to get lost in the minute-by-minute candles. It is easy to obsess over whether silver is up 2% or 3% today. But the most important signal isn't the percentage gain, it is the structure. The market just told us something profound. It told us that $61.50 is the floor. Think about that. A few years ago, $30 was the ceiling. Now $61.50 is the cheap price that billionaires rush to buy. The entire valuation model of silver has shifted. As we head toward the end of 2025, we are entering a specific seasonal window that favors the bulls. It is called window dressing. In this final chapter, we will explain why hedge funds who hated silver for a decade are about to become your best friends. We will explain the pain trade theory. And we will leave you with the final strategy for navigating the rest of December. The bear trap didn't just snap shut. It locked the door on low prices forever. We are in the second half of December. This is a critical time for Wall Street. It is the end of the fiscal year. Hedge funds and mutual funds have to send their annual reports to their clients. These reports list the assets they hold. Here is the psychology of a fund manager. If silver is the asset of the year, up massively, driven by tech and shortages, and the fund manager holds zero silver, he looks like an idiot. His clients will ask, why didn't we own the best performing asset? He gets fired. So what do they do in the last 2 weeks of December? They window dress. They buy the winners at any price, just so they can show it on their balance sheet on December 31st. They want to be able to say, look, we own silver. We were part of the rally. This creates an artificial, powerful tailwind into year-end. Funds that ignored silver at $30, $40, and $50 are now forced to buy at $63 just to save face. They are price insensitive. They just need the position. This institutional FOMO is what drives prices parabolic in late December. We saw it with tech stocks in the past. Now we are seeing it with commodities. The Samsung news gave them the cover story. The price action gives them the urgency. So if you see silver rallying on low volume during the holidays, don't be surprised. It is the smart money trying to look smart after being dumb all year. And you? You bought at $25. You bought at $30. You're selling your overvalued silver to their desperate fund. Or better yet, you aren't selling at all. Markets are cruel mechanisms. They are designed to transfer wealth from the many to the few. They usually move in the direction of the max pain trade. Right now, ask yourself, what outcome causes the most pain to the most people? Scenario A, silver crashes back to $50. Who does this hurt? The silver bugs. But silver bugs are used to pain. We have held through decades of suppression. We don't sell on dips, we buy more. So a crash doesn't generate liquidity. It just locks up supply tighter. Scenario B, silver rips to $75. Who does this hurt? The banks, who are short hundreds of millions of ounces. The industry, who needs silver for solar and batteries. The public, who are sitting in cash watching inflation eat their savings. The pros, the hedge funds, who are underweight commodities. Scenario B causes maximum pain to the establishment. It blows up bank balance sheets. It forces industry to panic. It humiliates the pros. Therefore, according to the laws of market sadism, Scenario B is the most likely outcome. The market wants to squeeze the shorts. The market wants to force the uninvested capital to chase the highs. The bear trap on Friday was the final attempt to get you off the train before it left the station. If you are still on board, you are aligned with the pain trade. You are the one inflicting the pain, not receiving it. Let's end with the macro perspective. Why does this $1.60 move matter? Because it confirms the wealth transfer. For 40 years, wealth flowed from real to financial, from factories to derivatives, from gold to treasuries, from silver to tech stocks. That tide has turned. The Samsung battery isn't just a gadget, it is proof that the physical world is reclaiming its value. You cannot print a battery. You cannot print a solar panel. You have to dig it. When the price of silver gaps up while the bond market wobbles, it is the market voting for reality. It is the market saying that an ounce of silver, which requires labor, energy, and geology to produce, is worth infinitely more than a digital entry on a Fed computer. You are living through a historic pivot point. Your grandchildren will ask you what you did during the resource crisis of the 2020s. Did you hold paper or did you hold metal? Friday was a test of your faith in that thesis. If you held, you passed. Monday is your reward. The day the bear trap failed. The day London panicked. The day the path to $65 opened up. I want to leave you with one final warning. Just because we are winning doesn't mean the war is over. The volatility will get worse. $2 swings will become $5 swings. $5 swings will become $10 swings. You need to harden your stomach. If you are over-leveraged, you will get washed out. If you're watching the ticker every second, you will get stressed out. The strategy remains simple. Accumulate physical, secure, unhedged miners. Sit tight. The market is doing the work for us. The shortage is doing the work for us. Samsung and China are doing the work for us. Let the smart money chase the price. We are already seated. Congratulations to the diamond hands. Enjoy the rally. Subscribe.